Moving on to Alphabet, company formerly known as Google. I don't know if you see a pattern going here with these tech companies changing their names. But anyway, company formerly known as Google. So also went through a corporate change. The reason same as Meta wanted to justify there's no longer a search based um, platform, that it offers more than just search. It offers, you've got Google Cloud, it offers enterprise software now, and other enterprise applications. It also, it's in streaming, Google, it's in, YouTube. It's also in streaming as well, and hardware. So it just wanted to move away from the name that signifies that it's just a search or an ad-based platform, and more into a diversified tech company. True, because it does have a myriad of offerings. Even though search is still a very dominant revenue driver, it still does offer quite a bit more than just it does offer more, a bit more than just what's this thing? Oh, my words are leaving me today. It does offer more than just search. Okay, now let us analyze this company. First and foremost, that is a typo. That is a serious typo. I don't know how the hell that happened, but it happened nonetheless. Let's move on with life. That should be 25%. So the margin on average is 25%. 25%. Let's fix that. Let's see if we can fix that quickly. That was 25. You know what? Screw that. Looks like we cannot fix it. But try to fix it. Looks like we cannot fix it. But that's 25%. 25. Remember, that's 25%. I'm saying it a lot of times because I don't want people to come and say, oh, that's a folks, they don't know math. That's 25%. That's a typo for my part. So sorry for that. Net margin. Very good. Very, very good. Pretty stable. Pretty stable for the past 3 years. Averages to 25%. Very, very stable. I mean, I love how stable its margins are. And you will see how in love I am with this company. But it's amazing. I mean, stable margins, it basically increasing costs, but at a decreasing rate. You will look at R&D growth decreasing. Sales and marketing pretty stable and stagnant. And you can see 12, 11, 10, stagnant. So same as Meta. Average of 11%. R&D as a percentage of revenue also stable. Keyword in what I've just said in the first 1 or 2 minutes is stable. Stable margin, stable cost basis. Now, you need to understand why this is the case, especially with the cost. Meta is expanding. I think, yeah, Alphabet is practically the only company in this industry, and you will see as we go on that spends less than the industry averages, and that raised a bit of an eyebrow because an investor, you'd be like, "Whoa, why are you spending so little on R&D? Why are all your costs going down? I mean, you should be spending more, to keep up with your competitors and the other big boys." But it isn't, and that can be down to basically one thing. Alphabet has matured a bit. It's no longer chasing growth. Um, like most companies, still, so it's not behaving like a startup, like a unicorn. No, 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 no. It's mature. So it does not need to spend for the sake of spending. At this stage, it needs to spend to justify growth. Any expenditure needs to justify growth. Now, it has kept its costs on a tight leash. All right, some costs it doesn't really need to spend that much R&D. I mean, Alphabet is in a stage in a cycle of its life where it's now realizing all the R&D that it has spent previously. You know, if you remember, Alphabet's spend on the Meta before even on the metaverse, right? It's spend on the metaverse, virtual reality and augmented reality. It's spent on that way before, way before even Meta came up with the name metaverse. It started to invest in it way before. So it's now just realizing that R&D. It doesn't need to spend any. It doesn't need to spend what it does not need to spend. So all spend in Meta all spend in Alphabet. When I look at these ratios, when I look at my analysis, that this represents a very mature company that's not chasing growth like a normal way, a startup or or a newly listed company or a unicorn might. No, no, no. It's at the stage where any growth will need to justify any increase in expenditure. So I love this cost control. The fact that it's on a tight, it's not spending for the sake of spending. It's spending while keeping costs on a tight leash, resulting in very stable and steady margins, resulting in pretty decent revenue growth, very excellent growth in net income. And still, I mean, this company makes $182 billion in revenue. That is just wickedly insane. And on top of that, from the 182 billion, it does not spend it wisely. We can see that with stable growth, very healthy margins, growth in sales result in a very, very good net income. So it increases this. So not only is it not only does it keep its cost control intact, it's turning its revenue into net income. So this is very, very good from Alphabet. I love it. All expenditure needs to justify growth. I love this. I love this. It's a very, very mature company. When I go to my return on equity, how productive, how efficient has Alphabet been in converting shareholders' capital into returns? S&P 500 over the same period returned 13%. Alphabet has returned 20%. Very, very good. Very, very good. Above market return. Above market return. Yeah. A bit of a tongue twister there. But again, very good. Healthy margins, good cost control, and it's not the fact that it's falling behind the big boys. No. Really spend heavily on things that some of these companies are spending into. Alphabet already been spending on that. AI, the metaverse. If you remember with Google Glass, I don't know how many of you remember. Google Glass was basically the first iteration of the Oculus headphones. The virtual reality or augmented reality headphones. It was the first iteration of that, and Alphabet spent that way before when it was still considered uncool. Now it's cool. Now companies want to venture into this offering augmented reality in your glasses. So and Google and Alphabet, or that then was Google, so Alphabet did that long ago. So again, I love this. I love this company. I love it. Stable margins, good cost control, not chasing revenue by unnecessary expenditure. All expenditure needs to justify growth. Solid growth in net income. Very, very impressive revenue that actually competes with some countries' GDP. It makes more money in a year than some countries. I mean, my goodness gracious, this is fantastic. Solid market rate of returns. I love it. So from a profitability point of view, big check mark. Current ratio. So now we're in the financial position. So financial position, is this company solvent, liquid? Is it not bankrupt? Does it not have too much debt? Is it too much of a financial risk? Does it have a stable balance sheet? Let's see if it doesn't. Current ratio. Again, Alphabet operates in this ad-based social platform industry, which is basically asset light but cash heavy, like we explained with Meta. So its current ratio is mainly driven by the huge stacks of cash it has on its balance sheet. Very good. Now I explained the current ratio in detail in the in the meta-analysis on what it is. But a quick recap: current ratio in 2020, Alphabet has three assets, three liquid, short-term current assets for each liability it holds, each short-term, each current, or each liquid liability it holds. That's very good. Again, you can just imagine for a person, imagine all your short-term debt, your credit card debt, money you also have to pay really quick. Imagine if you've got, for each one of those debt, you've got 3 times the liquid asset, the cash, the short-term investments, and other short-term market securities. That is very, very good on a 3-to-1 basis in favor of assets. Very, very good. Shows me it's a very liquid company and a very, very strong indicator of balance sheet strength. Now, the debt equity has increased a bit. Um, and you don't mind that. Again, I do not mind that it has been increasing a bit. And that again is mainly due to the fact that it's been taking on a bit more debt and the cash has been going down. But even though it's been increasing, it's still at 44% in 2020. In 2020, right? In 2020, it's still at 44%, which is basically 44 cents for each for your net worth. So for each dollar of net worth that Alphabet is worth, it only holds 44 cents in debt. That is very good. You can just imagine that as a human being. Imagine you hold for your net worth. Imagine for each dollar of net worth you are worth, only 44 cents of that is debt. That is incredibly good. That is still very good. I mean, it has increased, but you don't mind it taking on a bit more debt because, I mean, it does have the balance sheet for it. It does have the revenue for it. It does have the good, prudent financial discipline for it as well. The good top and bottom line goal for it. So you don't mind it taking a bit of debt because, again, I feel like this bit of debt is justified because it still has strong liquidity. Even though it's taking on more debt, it's still in the long term uh, stable in a stable financial position. It's taking on more debt, but I mean it's only 40. Debt only represents 44% of its net worth. It's really not that much. So again, increase, but still good. So again, just to summarize, Alphabet's its balance sheet not as strong as Facebook's, but then again, Facebook is only an $86 billion company in terms of revenue, and Alphabet is a $183 billion company in revenue. So it's more than double the size. So it can afford to take on a bit more debt. So I'm happy with it. So what the debt ratios, the current ratio and the debt to equity ratio, what they tell me is that Alphabet has a strong, a stable um, by financial position. It has a good balance sheet. It has a very, very, very good balance sheet. Yeah, I'm drooling at the current moment because wow, these are really, really, really good numbers. You look at the you look at the debt to risk relationship as well. The increased debt is, as you can see, followed by the increase in return. So it's very efficient with the use of its balance sheet to return equity. It's very efficient, productive with its income statement to return equity as well. So with its financial performance, also return equity as well. So I mean, very good. Let's move on to the cash liquidity ratios. Looking at my liquidity ratios, I have the cash from operations margin, cash from operations margins, or the net cash from operating activities margins. Same thing. Very good. very good. My goodness, and it's basically stable, but I mean, knockoff from 2019, but not really that big, and a massive improvement of 2 percentage points from 2019 to 2020, average of 35%. Lovely. So what this tells me is that for each dollar of revenue Alphabet generates, it's able to convert that. For each dollar of revenue it has, it converts it to 36 cents or 36% to cash from operations. So what this tells me is that Alphabet's operations can convert revenue into cash. At 36 cents, it's still good. I mean, 36% on 183 billion is a lot of billions. But very, very good, stable and strong. So, so not only is it stable, strong, as you can see, there has been a massive improvement, a bounce back in 2019 2020, but it's able to convert its operations into cash. Lovely. Supported by the fact that you look at the sufficiency of cash flow. Does it have sufficient cash flow from operations to pay lenders, reward your shareholders, as well as for investment activities, so to invest for future growth? Yes, it does. It's sitting at 1.16, average of 1.17. Very good. Remember, a good everything above one is fantastic. Everything above one tells you everything at one tells you have sufficient. Everything above one tells you have more than efficient. So it has more than efficient. This is very, very good. Efficient use of cash flow. So not only can it generate cash from operations, but it has enough cash flow to pay lenders, invest in the platform, in the operations for future growth, future prosperity. Vocabulary today, as well as enough to reward your shareholders. Efficient use of cash, I love it. Supported by a strong balance sheet, good cost control, stable margins, growth in the top and bottom line. Lovely. The yield has been a bit all over the place, but we don't mind it. Still on average over the past few years, returned 33% in the form of a buyback. Remember, Alphabet, like Meta, doesn't pay dividends, but it does do buybacks. So we're doing buybacks as a percentage of net cash flow from operations. So of the cash you have from operations, how much of that are you giving back to shareholders? And this is very, very good. Very, very, very good. Again, this ratio does hold more value when compared to other companies, and we will do that later on. But again, very, very good. So as a shareholder, I would love this. And then let's look at that. The P ratio. That thing is a lot. P ratio, how expensive is the stock? So for each dollar of earnings, how much are you paying above it? So for each dollar of earnings, you pay 20 or $30. For each dollar of earnings, you pay $30 to own Alphabet. That is a lot. That is a lot. Is it justified? You could say that, but wow, it's a lot. Yes, I mean stable margins, good cost control, growth in the top and bottom line, above market returns, solid balance sheet, efficient use of cash, ability to generate cash from the operations. I'm getting some in the form of I'm getting some reward from the company itself in the form of a buyback. I feel like that's a bit too steep. I mean, the operations do justify it a bit, but not. I mean, that's just too much for me. That's just too rich for my blood. I mean, for other investors, they could look at this and say, "Yeah, that I'm justified." But for me, that's just too rich for my blood. But overall, just in conclusion, as we saw with Alphabet, stable margins, good cost control, growth in top and bottom line, above market returns in the form of return on equity, ROE, solid balance sheet, ability to use the operators to generate cash, and sufficient cash available to pay lenders, reward shareholders as well as to invest, and it does give you a reward in the form of a buyback yield. But so it takes everything in terms of profitability, position, and liquidity, but it's just a bit too expensive at a P of 30 for my view. However, look at this return at 60% return. Many would say this justifies at 30. I mean, okay, maybe, but yeah, I mean, ugh, put too much of my blood. But anyway, good return. I mean, it's offered a really, really good return. I mean, been fantastic. But the question I think, and the same question could be asked about Meta, is 2020 was an exceptional year. I mean, can they maintain it in 2021? That's a good question, though. But again, a good performing stock. But for me, just too expensive. But that's enough from Alphabet.